When a bank that spent years manipulating silver prices suddenly becomes the largest accumulator, this isn't a shift in strategy. It's the final stage of a heist. December 2024. While Americans were distracted by holiday shopping and year-end market summaries, JPMorgan Chase quietly made a move that shook the silver world. The bank, infamous for paying nearly $1 billion in fines for precious metals manipulation and for traders facing jail for spoofing, just shifted 47 million ounces of silver into their eligible inventory. Their holdings skyrocketed from 12.3 million to 59.4 million ounces. The biggest single bank accumulation since the 2011 silver squeeze. Here's the kicker. Mainstream media was reporting weak industrial demand, low prices, and a nothing to see here narrative. Meanwhile, behind closed doors, one of the world's largest banks was quietly hoarding physical silver. Not paper contracts or futures, but actual metal stored in their own vaults. Eligible inventory versus registered inventory. A small technical detail, but it tells the full story. Eligible means they own it but don't have to deliver it. Registered? That's metal tied to futures contracts. By moving 47 million ounces to eligible status, JPMorgan is signaling preparation for scarcity, not selling into strength. Think about it. 47 million ounces is roughly 6% of global annual silver production. One entity quietly taking that much off the market should be front-page news. Yet CNBC, Bloomberg, and the Wall Street Journal were silent. December 2024 was not an ordinary month. While most Americans were wrapping up holiday shopping and tuning into the usual year-end market summaries, a monumental event unfolded quietly behind the scenes. JPMorgan Chase, a bank notorious for manipulating silver markets for over a decade, just executed a move that few noticed, but everyone should have. After paying nearly $1 billion in fines for price manipulation, after traders went to prison for spoofing, and after years of being the house rigging the casino, JPMorgan suddenly became the largest accumulator of physical silver in more than a decade. Not futures contracts, not paper derivatives, actual metal. 47 million ounces, quietly moved into eligible inventory in COMEX warehouses. Their holdings exploded from 12.3 million ounces to 59.4 million ounces, the single largest bank accumulation since the 2011 silver squeeze. Think about this for a moment. At a time when financial media was feeding the narrative of weak industrial demand, soft prices, and range-bound markets, JPMorgan was quietly doing the opposite. Every mainstream outlet was telling the public, nothing to see here. Yet, behind the curtain, a massive accumulation was taking place. This is not conspiracy theory. It's COMEX warehouse data, public and verifiable, showing a bank preparing for a major shift while everyone else was distracted. Why eligible inventory? No, it's a technical distinction that matters. Registered inventory supports futures contracts. Eligible inventory is essentially a private stash. When JPMorgan moved 47 million ounces into eligible status, they weren't making it available for delivery. They were building a private reserve. Scarcity, not sale, was the goal. Think about the psychology. A bank that spent years pushing silver prices down is now quietly hoarding physical metal. They paid fines, endured prison sentences for their manipulation, and now they're switching sides. The house is no longer playing against you. It's betting alongside the players. To put 47 million ounces in perspective, that's roughly 6% of annual global silver production. Imagine a single entity quietly acquiring 6% of the world's copper, wheat, or oil output. Front page news, right? But in silver, there's radio silence. CNBC, Bloomberg, WSJ, nothing. Why? Because silence benefits accumulation. Loud accumulation distributes to uninformed buyers. Quiet accumulation allows banks to buy from those who don't know better, from retail sellers, oblivious to the real story. And this isn't the first time we've seen the playbook. Remember gold in 2020? Banks accumulated loudly, media hyped new highs, and retail investors chased the rally. Institutions sold into that enthusiasm. Silver? Cricket sounds. No hype, no analyst upgrades, just raw warehouse data documenting the largest accumulation move since silver traded $50 per ounce in 2011. JPMorgan's move signals preparation, not speculation. Scarcity is coming. Paper markets continue to pretend everything is fine while institutions quietly fortify their positions. The question isn't whether JPMorgan did this. The question is why now and what they know that our financial media isn't telling us. The speed of accumulation. JPMorgan didn't slowly gather ounces over years. They executed a calculated rapid buildup in just weeks. From early December to the final week of the month, the eligible inventory shot up by 47 million ounces. That kind of movement sends ripples through supply chains. Yet because it occurred quietly in COMEX warehouses, most market participants never noticed. Analysts tracking silver futures were distracted by normal market chatter. Prices are flat. Industrial demand softens. No inflation impact yet. Meanwhile, an institution that has historically dominated silver manipulation quietly rewrote the rules of supply behind closed doors. The mechanics of this accumulation are as fascinating as the numbers. Eligible inventory, unlike registered metal, is not available to satisfy open futures contracts. This distinction is subtle, but it reveals the strategy. JPMorgan was not preparing to sell or deliver metal in the immediate term. Instead, they were strategically hoarding, creating scarcity that would eventually manifest in price dislocations. This is the playbook of an institution anticipating systemic shifts, where the current market narrative is a deliberate distraction from the underlying reality. Why hoard in December 2024 specifically? Context is key. Global macroeconomic signals, interest rate trends, rising inflation, geopolitical tensions, and central bank interventions suggested an imminent reset in commodity markets. JPMorgan's historical behavior shows they thrive on foresight and asymmetry. When markets are mispriced or narratives misaligned with fundamentals, banks with access to physical metal can exploit both. By securing 6% of annual global silver production in a single sweep, JPMorgan essentially positioned itself to benefit from any sudden supply-demand dislocation. Another layer to consider is media narrative versus reality. Financial journalism continues to portray silver as a sleepy, non-essential commodity. Headlines emphasize weak industrial demand, ETFs inflows and outflows, and fluctuating futures prices. But physical metal doesn't lie. Warehouse data, when examined carefully, tells a story entirely disconnected from the mainstream narrative. By comparing registered and eligible stocks, one can see that JPMorgan's action was not a casual accumulation. It was a strategic hoard designed to control scarcity. This is compounded by the psychological impact on retail investors. Most people buy silver based on price signals, charts, or news headlines. They react to volatility, chasing trends or selling during perceived slumps. Meanwhile, a sophisticated institution quietly acquires millions of ounces, while retail investors remain unaware. When the market eventually reacts to scarcity, price spikes will appear sudden and unexplainable to the average buyer. But for those who understand accumulation patterns, it will be the predictable outcome of a calculated, multi-decade strategy. Finally, we must address the elephant in the room, JPMorgan's history. From 2008 onwards, the bank has been fined repeatedly for manipulating silver and other metals. Yet, despite fines, scrutiny, and regulatory attention, the bank continues to dominate warehouse positions. This raises critical questions. If an institution can repeatedly manipulate markets legally and illegally, what safeguards truly exist for retail participants? And when they decide to hoard rather than sell, what does that mean for systemic risk? As Section 2 closes, the focus shifts toward implications. Accumulation at this scale doesn't remain hidden forever. Inevitably, market stress will expose the discrepancy between paper and physical markets. The current illusion of oversupply masks a reality of concentrated ownership. JPMorgan's accumulation signals that scarcity, disruption, and price volatility are not theoretical. They are imminent. To fully grasp the magnitude of this move, one must understand how COMEX silver operates. Unlike paper assets, physical silver has two categories, registered and eligible. Registered metal is available to satisfy immediate delivery obligations. Eligible metal sits in warehouses, but is not allocated for contracts. JPMorgan's accumulation was overwhelmingly in eligible inventory, metal that cannot be delivered against open futures. This distinction is subtle but critical. It demonstrates control over the market without triggering immediate price movement. They are building leverage silently, positioning to dictate supply when strategic timing aligns. The sheer scale of 47 million ounces is staggering when put into context. Annual global silver production hovers around 900 million ounces. JPMorgan, by quietly hoarding 6% of yearly output, effectively controls a disproportionate slice of potential supply. Historically, such concentration precedes dramatic market corrections. This is not coincidental. It is a repeatable pattern observed in metals markets dating back decades. Institutions with both capital and foresight can compress supply, induce scarcity, and profit when the market reacts. Retail investors perceive volatility as random, but these movements are carefully orchestrated by those with physical leverage. Next, consider the timing. December 2024 saw subtle but significant macroeconomic cues: rising commodity-backed currencies, interest rate uncertainty, and geopolitical tensions affecting industrial demand. These factors create an ideal backdrop for accumulation. By hoarding silver at this moment, JPMorgan positions itself not only to profit from scarcity, but also to capitalize on a market reset. Any sudden shift in supply-demand dynamics will magnify the impact of previously accumulated positions. Timing is everything in this game. The move was deliberate, calculated, and aligned with historical patterns of strategic accumulation. The interplay between paper and physical markets adds another layer of complexity. Futures markets are highly liquid, influenced by speculation, ETFs, and derivative positions. However, physical supply is finite. when a significant portion of physical silver is concentrated in a single institution. The illusion of abundance persists on paper, while real scarcity builds behind the scenes. Investors who track only price charts or short-term sentiment miss this critical imbalance. Understanding the distinction between paper signals and tangible supply is essential to anticipating market shocks. Furthermore, JPMorgan's prior behavior underscores the pattern. Past manipulations, spoofing, silver suppression fines, and fines for other metals highlight their capability to control pricing narratives while simultaneously executing large-scale physical accumulation. They combine regulatory loopholes, warehouse leverage, and market timing to maintain dominance. Retail investors, following conventional wisdom, remain unaware of these mechanisms. When scarcity is eventually revealed, price spikes will appear sudden and unprecedented, even though they were predictable to anyone analyzing inventory movements and historical patterns. Psychology plays a key role. Most market participants rely on headlines, analyst commentary, and chart patterns. They react to perceived supply, price trends, or speculation, often missing underlying accumulation. This behavior creates an asymmetry. Institutions act with knowledge and patience, while the public reacts emotionally. The result is a predictable disconnect between retail perception and market reality. This dynamic amplifies the impact when scarcity-driven moves finally manifest, resulting in sharp, rapid price movements that appear irrational to the uninformed. Finally, Section 3 emphasizes the broader implications for the market. JPMorgan's accumulation is not a passive event. It is a strategic statement about control, timing, and the inevitability of volatility. By consolidating physical silver at scale, they influence both paper and physical markets, effectively positioning themselves to dictate supply when external triggers, macroeconomic, geopolitical, or financial, initiate market stress. This consolidation signals that disruption is imminent, and participants ignoring inventory data are likely to be blindsided. As this section concludes, one takeaway becomes clear. The combination of scale, timing, and market mechanics ensures that the accumulation is more than an investment. It is a structural shift. Understanding eligible versus registered inventories, historical patterns, and psychological asymmetries is critical for anyone hoping to anticipate market movements. For retail investors, ignoring these insights risks being caught off guard, while those who observe and analyze may recognize opportunities before the broader market reacts. To comprehend this fully, one must first understand market depth and liquidity dynamics. COMEX silver futures are highly liquid, with thousands of contracts traded daily. These contracts, however, represent only a fraction of the underlying physical metal. When an institution like JPMorgan accumulates massive quantities in eligible inventories, it effectively constrains supply while maintaining the appearance of normal liquidity. Traders reacting to futures prices see no immediate disruption, but the hidden physical accumulation quietly shifts market equilibrium. This distinction between visible price action and hidden supply is critical. Futures markets are dominated by speculators who rarely consider actual inventory. As JPMorgan's eligible silver accumulates, the disparity between paper abundance and physical scarcity grows. This creates a latent tension in the market. The more the public believes silver is abundant, the more concentrated the real supply becomes. Historical precedents show that when such disparities reach a tipping point, the market experiences rapid repricing, often triggered by minor catalysts. Recognizing these underlying pressures is essential for anyone seeking to anticipate major moves. Another key factor is positioning against shorts. Hedge funds and commercial traders often short silver, assuming prices will remain suppressed. By quietly accumulating massive quantities, JPMorgan positions itself to create a short squeeze. As inventory tightens, short sellers face margin pressure, forcing them to cover positions, which accelerates upward price movement. This mechanism, while predictable in hindsight, often blindsides retail investors. Timing, patience, and scale are critical. JPMorgan is executing a deliberate strategy that maximizes leverage over both price and psychology. Additionally, the institution's history of manipulation provides insight into strategy. Past instances of spoofing, futures market control, and physical warehousing demonstrate a systematic approach to combining legal loopholes, market influence, and psychological pressure. Each move is designed to minimize public awareness while maximizing future gains. The December 2024 accumulation is not an isolated event. It follows decades of strategic positioning. By understanding these historical patterns, one can recognize that the current scenario is the culmination of long-term planning, not a spontaneous reaction to market conditions. Timing remains another crucial aspect. Market catalysts in late 2024, including inflationary pressures, industrial demand shifts, and central bank policy uncertainty, created an ideal environment for accumulation. By hoarding physical silver at this juncture, JPMorgan sets the stage for an amplified market reaction once these macroeconomic factors materialize. Retail traders who rely on conventional indicators, such as moving averages or short-term price trends, remain unaware of the underlying structural shift. Awareness of inventory concentration and market timing is therefore essential for anticipating potential volatility. Psychological manipulation also plays a significant role. Investors often trust mainstream narratives, believing that prices reflect true supply and demand. JPMorgan's strategy exploits this bias by accumulating without immediate price impact, creating an illusion of stability. This disconnect between perception and reality allows them to consolidate power quietly. When scarcity eventually becomes apparent, the market reacts violently, reinforcing the perception of unpredictability, while the institution profits from foresight. Finally, Section 4 highlights the broader implications of this accumulation for both retail and institutional participants. By controlling a significant portion of physical silver, JPMorgan influences market dynamics at multiple levels: futures pricing, margin calls, and retail sentiment. The convergence of scale, timing, and psychological pressure ensures that future price moves will not only be substantial, but also rapid and unexpected to those unprepared. Understanding these mechanics is not optional. It is critical for anyone seeking to navigate the silver market intelligently. The takeaway from this section is clear. Market liquidity and visible price action are often misleading when large institutions accumulate physical assets. Recognizing the gap between paper markets and tangible supply, understanding short positioning dynamics, and observing timing and psychological influence are crucial for anticipating market behavior. In essence, JPMorgan Osborne's December 2024 accumulation represents both a strategic coup and a warning. Those unaware of the hidden mechanics are likely to be blindsided when scarcity manifests. COMEX categorizes physical silver into two inventories: registered, which can be immediately delivered against futures contracts, and eligible, which meets quality standards but is not currently registered for delivery. This subtle difference has profound implications. JPMorgan's accumulation primarily targets eligible silver, meaning they control metal that could, at a later date, be converted to registered supply when strategically necessary. By hoarding eligible silver, the bank creates an invisible bottleneck, constraining the market without triggering immediate alarm. Understanding the mechanics of eligible versus registered is critical. Registered silver is what hedge funds, traders, and industrial buyers monitor closely. It represents the deliverable supply and often dictates short-term pricing. Eligible silver, on the other hand, is effectively dormant in the market. Its existence is known only to insiders who track COMEX inventory shifts closely. When a significant portion of eligible silver is held by a single institution, it gives them latent control over potential market supply, enabling strategic influence over pricing and trading behavior. This dynamic feeds directly into the psychology of short sellers. Traders betting against silver monitor registered inventories and often assume that sufficient supply exists to cover any price spikes. JPMorgan's eligible accumulation undermines this assumption. Once the bank begins converting eligible to registered, even a small percentage shift can trigger margin calls, forcing shorts to cover. This creates a delayed yet powerful squeeze, magnified by the surprise factor. Retail investors, focusing only on headline inventory numbers, often fail to anticipate this latent risk, making them vulnerable to sudden market shocks. Industrial demand adds another layer of complexity. Silver's unique dual role as both an investment and industrial commodity amplifies the effect of tight supply. Electronics, photovoltaics, and medical technologies all rely on silver, and sudden scarcity can ripple into pricing across multiple sectors. By controlling eligible inventory, JPMorgan can exert influence not just over trading behavior, but also over broader supply chains. This multifaceted control further emphasizes why understanding the eligible versus registered distinction is not academic. It is essential for market survival. Moreover, historical patterns reveal how institutional accumulation shapes narrative and perception. In prior instances, when large institutions consolidated eligible silver, mainstream media reported inventory increases without highlighting potential delivery bottlenecks. The public, observing seemingly normal supply levels, remained unaware of the underlying scarcity. This allowed institutions to quietly position themselves for dramatic moves while avoiding regulatory scrutiny or market panic. December 2024 exemplifies this approach. Accumulation occurs stealthily, yet its implications are profound and inevitable. Timing plays a crucial role. By accumulating eligible silver during periods of moderate price movement, JPMorgan avoids drawing attention while maximizing future leverage. This is compounded by macroeconomic uncertainty. Rising inflation, industrial demand shifts, and geopolitical tensions all enhance the value of controlled silver. The bank's strategy leverages these conditions, ensuring that when market participants finally recognize scarcity, the resulting reaction is both swift and significant. Psychological leverage remains a core tool. Investors conditioned to monitor only visible data underestimate the power of hidden inventories. JPMorgan's eligible hoard represents a latent psychological weapon. It forces shorts, industrial buyers, and retail investors into a reactive position rather than a proactive one. This strategic asymmetry ensures that the institution benefits from both market movements and behavioral biases, reinforcing the efficacy of its accumulation. Finally, Section 5 emphasizes the broader lessons. Not all supply is equal, timing is everything, and hidden inventory dynamics can dramatically influence market outcomes. JPMorgan OAS December 2024 strategy exemplifies how elite institutions manipulate both tangible and psychological factors to secure advantage. Awareness of eligible versus registered dynamics is therefore indispensable for anyone serious about navigating silver markets. The key takeaway: controlling latent supply, understanding inventory classifications, and anticipating short covering dynamics provide a crucial edge. Those who ignore these subtleties risk being blindsided by sudden volatility, while those who grasp them can anticipate the next phase of market movement. The eligible versus registered distinction is not a technical footnote. It is a strategic fulcrum that shapes the entire silver market's trajectory. Unlike obvious market interventions that attract attention, their method relies on gradual positioning combined with the careful use of derivative instruments. By incrementally increasing holdings in both futures and physical silver, JPMorgan minimizes headline risk. This stealth accumulation ensures that casual observers, including media outlets and retail investors, perceive normal market behavior, even as the bank quietly acquires tens of millions of ounces. The method is deceptively simple in theory, but sophisticated in execution. JPMorgan leverages futures contracts to hedge and amplify their physical holdings, creating a dual-layered control structure. On the COMEX, futures allow the bank to influence short-term pricing without immediately touching the underlying physical market. Meanwhile, eligible silver acts as a strategic reserve, poised for conversion into registered supply at the opportune moment. This combination of derivatives and physical inventory creates a powerful asymmetry. The bank can push prices in its favor while limiting risk exposure. Historical precedents reveal that these patterns are not new, but rather refined over decades. JPMorgan OAS prior fines for silver manipulation and spoofing illustrate the lengths institutions will go to control supply and pricing. Each previous episode provides lessons in market psychology, showing how traders respond to inventory changes, price spikes, and headline narratives. December 2024 demonstrates a culmination of these lessons. The accumulation is massive yet subtle, exploiting both market mechanics and behavioral tendencies. One critical factor is timing relative to market cycles. Silver's price history is marked by recurring phases: accumulation, manipulation, and eventual release. JPMorgan positions itself to capitalize on each phase. During accumulation, stealth and patience are paramount. During manipulation, the bank leverages the perception of ample supply to encourage shorts and reduce market resistance. Finally, during release or conversion, the latent supply held as eligible silver can be transformed into registered ounces, triggering margin calls, short squeezes, and price volatility. Each phase is meticulously planned to maximize profit and minimize exposure to regulatory scrutiny. Psychology plays a pivotal role. Short sellers often underestimate latent supply because they focus solely on visible registered inventories. Industrial buyers assume sufficient silver exists for operational needs. Retail investors track headlines and spot-check price trends. By contrast, JPMorgan controls the unseen portion of the market, allowing it to dictate outcomes indirectly. The bank effectively creates a scenario where market participants react to movements instead of proactively anticipating them, granting a substantial strategic advantage. Industrial demand is another layer in the strategy. Silver's dual purpose, industrial and investment, means scarcity can trigger cascading effects. Electronics, solar panels, and medical applications rely on consistent supply. By controlling latent inventory, JPMorgan not only manipulates trading behavior, but also positions itself as a critical gatekeeper for industrial usage. This enhances leverage in negotiations, futures pricing, and derivative positioning. Section 6 also highlights media complicity in the illusion of normalcy. Headlines rarely emphasize eligible versus registered distinctions or the true scale of institutional accumulation. By keeping the public unaware of hidden bottlenecks, JPMorgan ensures that market reactions remain predictable and advantageous. Analysts focus on surface metrics, while the bank maneuvers behind the scenes, quietly consolidating power and shaping narrative. Finally, the takeaway from this section is clear. Understanding strategic accumulation, timing, and psychological leverage is essential for anyone seeking to navigate silver markets effectively. JPMorgan's December 2024 operations exemplify a sophisticated, multi-layered approach that combines inventory control, derivative strategy, and market psychology into a single coherent plan. Awareness of these dynamics provides a critical edge, allowing observers to anticipate market reactions and position themselves accordingly, rather than being blindsided by institutional moves. The key insight: accumulation is never random. Every action, from futures positioning to eligible silver hoarding, is part of a calculated strategy. Those who recognize the orchestration can forecast potential squeezes, volatility spikes, and narrative shifts, while those who ignore these subtleties risk being trapped in reactive, costly decisions. JPMorgan's strategic accumulation interacts with the behavior of retail investors, hedge funds, and commercial players. While price charts and inventory reports provide data, the real advantage comes from understanding how market participants perceive risk and opportunity. JPMorgan exploits this perception gap by controlling the timing and visibility of supply, creating scenarios where traders act predictably, often to the bank's benefit. Retail traders typically respond to obvious signals: price spikes, news reports, or commentary from analysts, without insight into hidden inventories or derivative hedges. Hedge funds may track market sentiment and position aggressively, but without knowledge of latent eligible silver or off-exchange accumulation, they are reacting to a distorted reality. Commercial users, focused on industrial needs, assume sufficient supply exists, failing to anticipate potential bottlenecks. JPMorgan leverages these blind spots, orchestrating movements that appear natural while subtly nudging market participants into predetermined behaviors. A central tool in this psychological orchestration is the perception of abundance versus scarcity. By quietly hoarding vast quantities of silver in eligible form, the bank creates the illusion of market equilibrium. Visible supply appears sufficient, dampening panic and keeping shorts comfortable. Yet, beneath the surface, a massive latent supply exists, ready to be converted into registered ounces at strategically advantageous moments. This dual reality enables the bank to manipulate timing, inducing margin calls, short squeezes, or volatility spikes when conditions are optimal. Section 7 also examines derivative instruments as leverage amplifiers. Futures, options, and swaps allow JPMorgan to magnify exposure without immediately drawing attention. By layering derivatives atop physical holdings, the bank can influence price action while minimizing capital tied up in physical silver. This strategy creates a self-reinforcing cycle. Price moves trigger derivative adjustments, which in turn influence market sentiment, prompting further reactions from shorts and longs alike. The orchestration is subtle but highly effective, blending financial engineering with behavioral insight. Timing remains critical. December 2024 marked a convergence of factors: economic uncertainty, inflation trends, and regulatory ambiguity that amplified the effectiveness of JPMorgan's positioning. Historical cycles suggest that silver moves in waves: accumulation, manipulation, and eventual release. By anticipating these waves, the bank can maximize profit while minimizing scrutiny, turning market psychology into a tool rather than a risk. Another factor highlighted in this section is institutional information asymmetry. JPMorgan and similar entities possess data and analytics far beyond public access. They can track every significant commercial move, production report, and inventory shift, creating a strategic advantage that ordinary traders cannot replicate. Knowledge of eligible versus registered silver, margin structures, and derivative exposures allows the bank to predict reactions before they occur, effectively setting the stage for controlled volatility events. The media narrative plays a supporting role. Headlines often focus on price swings or macroeconomic factors, rarely delving into hidden supply dynamics or institutional accumulation. This lack of transparency ensures that the public reacts to surface-level events, while the bank executes long-term strategies with minimal interference. Analysts, commentators, and retail investors interpret data in isolation, unaware that underlying leverage and hidden inventories dictate the real market mechanics. Industrial demand remains a silent influencer. Silver's critical role in electronics, solar energy, and medical devices means that any subtle supply restriction can ripple through multiple sectors. By controlling eligible silver, JPMorgan not only manages market perception, but also positions itself as a key gatekeeper in global supply chains. This dual advantage, financial and operational, enhances leverage, increases negotiating power, and secures long-term strategic positioning. The central lesson is that market psychology and hidden supply control are inseparable in understanding JPMorgan as strategy. Price action is not random. It is the result of deliberate orchestration, timed interventions, and calculated perception management. Traders who fail to recognize these subtleties are often caught off guard, while those attuned to these dynamics can anticipate volatility spikes, short squeezes, and shifts in narrative. In conclusion, this section reinforces a critical insight: perception is as important as reality. By blending strategic accumulation, derivative leverage, and behavioral insight, JPMorgan effectively rewrites market outcomes in its favor. Recognizing these patterns is essential for anyone seeking to navigate silver markets effectively, providing foresight and positioning that reactive strategies cannot achieve.